Hi, everyone, and welcome to the new face of NPS, our special LinkedIn Live show where we break down what's changing in the world of retirement investing. India's retirement preparedness is showing a steady improvement, with the India Retirement Index study reporting a national score of 48, up from 44 in 2022. One of the key findings of the study also shows awareness towards NPS has climbed from 59% to 66% way back in 2022. If you're someone who contributes to NPS every month or have been thinking about investing in NPS, today's session will help you understand what's new with NPS, what's changing, and how it could benefit you. To share the side of story, we have with us Mr. Rahul Bhagat, CEO of DSP Pension Fund, and Mr. Ramneek Kundra, CIO of DSP Pension Fund. Rahul and Ramneek both come with decades of experience in the financial services industry, and together they will help us understand the latest updates, including the much talked about the multiple scheme framework or MSF under NPS. So, Rahul, we start with you. We have been hearing a lot about the recent changes that PFRDA has brought about and has introduced the MSF. Can you tell us what's new in the NPS landscape and MSF, and how PFRDA is actually going to help us be more prepared and be pension ready as a nation?
Thank you, Samana, for having us today. And thank you, all the people who have joined us for this webinar. Uh, uh, in fact, what's happening in PFRDA space is a lot. With the PFRDA chairman coming in, uh, he has recently joined, and he has brought in several forward-looking initiatives which will strengthen the NPS ecosystem and make India pension ready. He has set a clear and ambitious goal to 3x the AUM over the next 5 years. Currently, out of the total AUM of around 15.8 lakh crores, the private sector contributes roughly around 3.3 lakh crores, which is in percentage of close to 21% of the total asset base. Now, for the NPS to achieve this 3x growth target overall, the private sector participation or the non-government participation will need to increase significantly. To enable this, PFRD has rolled out multiple initiatives aimed at expanding coverage, enhancing customer experience, and boosting the industry participation. Uh, you would see some of these reforms have already taken place, and some of the reforms are under discussion and under public participation. For example, uh, the exit regulations are getting changed. You will see a different form of NPS, especially when you're retiring. Uh, Today, you can withdraw 60% of your total corpus at retirement, and 40% you have to buy annuities. With these reforms, you would actually be able to withdraw more, up to 80%, and less towards annuities, which is 20%. Similarly, multiple reforms are happening, and one such major step is the launch of NPS, that is multiple scheme framework, which was launched in October 1st by all the pension fund managers. And we can see a lot of further reforms happening as we talk and in the near future as we move forward.
Great. So while we have heard a lot about these changes, let's talk about the star of the show, or MFS. Now, a lot of individual investors like us, we do some investing. Most of us have started investing in NPS bit by bit every month. I would want to know, on behalf of my audience here, what's new in NPS? What is it that is going to change? And like you mentioned, a couple of interesting features. How is MSF going to help us achieve those?
Uh, to get into the MSF scheme, I'll also talk about a little bit of the background, and I'll have a few slides to share. I'm moving into that, sharing my deck. if you look at multi MSF, it's under this framework, PFMs can now offer multiple investment schemes with different risk return profiles and offer this to the subscribers. And as a result of which, the subscribers will get a lot of flexibility and a choice, and they can actually align their NBL investment with their financial goals and risk appetite. Now, this is a remarkable breakthrough. And if I have to look at it, let me explain you further what is MSF and what reforms under the MSF scheme has been brought in. Now, as I mentioned under the MSF, now pension fund managers can launch their own schemes. So what it means is earlier, as pension fund managers, we couldn't launch a scheme. We were only managing the funds under the scheme which was launched by PFRDA. Everybody had the same scheme. For example, we had active allocation, auto allocation. With an active allocation, the customer could choose how much he could go into equity, which was allowed. 75% could go in equity, the max. Balance in corporate bonds in G6, he could go as high as 100%. And we also had alternate assets as an asset class where he could invest 5%. And the second option he had was auto allocation, where the money would get auto allocated into different asset classes depending on what choice he has taken. He has taken aggressive, moderate, or uh, least risky propositions. Depending on that, his uh, lifestyle based and his choice, the allocation from equity will get reduced to debt over a period of time. Now, with the multiple scheme framework, the pension fund managers can launch their own schemes. Uh, Means we can go as high as 100% in equity and as low as 0% equity. And we can have multiple schemes of which can be offered by fund managers. So under this framework, there we can launch high risk, low risk, and medium risk categories, and the customers, depending on where he wants to invest in, can choose him his choice of scheme being offered by the pension fund managers. Now, the second major reform which I've seen is now subscribers, as I mentioned, can now open multiple schemes. Earlier, subscribers used to have only either active or auto choice. Now, as of today, he can choose the multiple scheme offered by multiple pension fund managers, and he can invest in these schemes simultaneously across different pension fund managers. So today, if he is investing in DSF, he can also DSP, he can also invest with other fund manager. And suppose he has 100, he can invest either 10 each in different schemes in 10 fund manager, or he can have a higher exposure towards one of the fund manager and lower exposures or towards other fund managers. Over and above, what has happened is now the charge structures got unified in the sense earlier the subscriber used to pay charges to the fund manager and also distribution charges to the POPs. Under the POP, he was paying account opening charges, he was paying servicing charges, he was paying exit charges. There was a persistency charge which was being paid. So the customer actually didn't know how he was paying because he was paying separately to the PFM and he was paying separately to the POPs. Now, with the new scheme, the only charge is one charge which is levied under the scheme is 30 basis point, and there is no distribution charge in it, only the fund management charge. If at all, if the distribution has to be paid, distributor has to be paid, that he will be paid by the PFM from this 30 basis point, which is a big shift from the previous schemes earlier which he was paying. So from a small investor perspective who had little money to invest, he was paying a lot of charge because of the minimum account opening charge, minimum 50 basis point, which was going towards contribution, so and so forth. But today it's purely, if it's an AUM based charge, means depending on my AUM, I will be charged whether the charge structure is flat 30, but the amount I'm charged will increase if my AUM increases. Having being brought this structure, the overall scheme is still very low cost, under low cost structure, which was the basic objective of PFRD under NPS, and we are not defeating that objective at all. Beyond this, the major breakthrough is the vesting period has reduced to 15 years. Now, we used to get a lot of feedback from customers saying that why I'm investing for long term, why only I cannot touch my money till retirement. Now, what PFRD has done is you come into the scheme. If you have less number of years, or if you want to stay less into NPS, you can withdraw your money after 15 years, or the exit regulation will kick in after 15 years. Earlier, if a subscriber was 25 years of age, he had to stay till 58 or 60, depending on what is the retirement age, into the scheme. Today, if a 25-year-old young guy comes in, he can actually close the scheme by 40, commute 40% and balance 60%, commute 60% and balance 40%. Minimum he has to buy annuities. So that laws are applicable, and the vesting period has been reduced to 15 years. He doesn't have to stay in the scheme till he retires. Another option which MSF brings to the table is that if you have chosen a fund manager under MSF scheme, and for some reason you are not liking the returns or the performance of the MSF scheme, you can always switch back to the common scheme. So when I say common scheme, it means the default scheme which exists today, where all the NPS money is invested. You can go back to active allocation or auto allocation in the common schemes from the MSF framework, or you can also invest money into other schemes launched by other fund managers. That's a choice given to you. Now, over and above this, there's another uh, addition or reform which MSF has brought in. Now, fund managers can value add a lot of services along with the fund management. So, can we club your MSF scheme along with life insurance offering, health insurance offering, accidental insurance offering? The answer is yes. So it makes a very, very compelling position if that is being offered. Currently, this has not started, but I think as we move forward, we'll see a lot of value added services will start getting added along with the MSF scheme. For example, uh, there could be a proposition where a bank led fund manager is offering banking products along with the scheme. Very much possible. So the overall value proposition which is for the subscribers has increased multiple folds under MSF, which was not there in the common schemes earlier. And uh, it's a beautiful package where customers can choose which fund manager, their asset class, their risk appetite, and their objective of wealth creation, and basis that they can expect the funds to perform and achieve their goals.
Rahul, do you want to add any more of the features? A lot of interesting ones. And I would request you to maybe do a little bit of summary towards the end of our conversation. So we get an opportunity to have equity exposure anywhere between 0 to 100. The charges have been reduced. You also mentioned that the vesting period is reduced to 15 years, though we would want to know a little more about it, because a lot of our audience could be quite the younger generation who probably would be thinking about NPS as one of the investing options. You also mentioned about the value added services being offered. Now,
Yeah.
my next question is, um, you know, can the existing NPS investors to get benefit of these changes, or is this only going to be for new joiners who's going to be just starting their investing? And if I am already having an NPS account, can I make use of this new framework?
Absolutely, very valid question, Samana. This is available to all the new and existing customers. So existing customers cannot shift their existing money into MSF, but their future contributions can go towards MSF scheme. So the existing money which is lying in NPS is lying in the common schemes, whether it's actively managed auto or under auto allocation. But fresh money, the fresh contributions can be diverted towards MSF by the subscribers or the customers. There are a lot of corporate NPS subscribers who could have also joined the webinar today. For their knowledge, I would say is if you want to take advantage of these schemes, you can go back to your employer and say, we want to choose this scheme, please enable it for us to invest in it. And if they are not done it, you can also uh, request, you can check your CRA website or apps and see if these schemes are coming or not. Go back to your employer and say, we want to choose this. And so that's it's the choice is made available by the employer if it's not been made. And for it's easier for you to then invest incremental contributions going into the MSF scheme for your. So yes, so Manna, to answer your question, it is very much possible for existing NPS customers as well as new customers to avail the MSM scheme.
Great. Rahul, I do have a lot of other questions in my mind when it comes to the interesting MSF schemes. But I have a question now for Ramneek. Ramneek, we hear a lot of these changes that Rahul just spoke about. We would want to know from the fund manager's side, does this mean more work and compliance, or are you going to be getting a lot more freedom and innovation to serve the investors better?
So the strategy, how we manage money, it doesn't change a lot. Probably incrementally, we are not going to deploy stocks that are hold in our existing portfolio, and probably, there would be some changes. It could be that the stocks that we are incrementally adding to our portfolio would have more weightage in the new scheme, but essentially the fundamentals remain the same, and over time the portfolios may look very similar to each other. So it doesn't change a lot, but yeah, it adds a lot of operational work for the team, and we are happy to do it. uh, if this solves us any of the subscribers problems and help them grow their net worth.
So just to add to your question, Savannah, I would like to add that this definitely gives a leeway to a fund manager in terms of, you know, you can go as high as 100% equity. If the fund manager decides to launch a scheme where they want to have a dynamic allocation, uh, it will as per the choice of the fund manager to invest in either debt or equity scheme depending on the market situations. Definitely, it's just not definitely, some part of administrative burden comes in with new schemes coming in from the back office and front office both. But I think it also, uh, as we talk, the regulator is also looking at expanding the investment framework from BSE 200 to BSE maybe 300 or 400. It is soon to come. And that is, as and when it comes, it will give a lot of leeway to the fund manager to be innovative in how he manages the fund, which he is restricted to today because 200 stocks are hardly, a universe. And
Absolutely.
then it's just not large cap. Uh, Today also we have some mid caps and large caps, mostly large caps, but with the universe expanding into say BSC 300 or 400 or 500, I don't know what is going to be. Parallelly, the regulator is also thinking of allowing the fund manager to invest in metals like silver and gold. Now, that's a natural hedge for any fund manager to invest in depending on the market condition. If market condition not conducive for the equity markets, he could take a call and say, I would invest, say, 10% in metals because that could be a natural hedge and take care of the negative returns which we expect in the equity. So it is means I think this opens up a lot of play for or gives a room to the fund manager to play in the sense not just play seriously play with the money, but to apply his mind and create different set of opportunities for investor to get the kind of return they're expecting from the asset allocation he has proposed to them and aligning with this investment philosophy. So with this respect, I think it's phenomenal. And as we move forward, we'll see this space evolving. And as it evolves, it will give a lot of room for fund manager to be innovative. Currently, his room is very, very limited because the investment framework is limited to BSE 200 and not beyond.
Understood. So now I'm a little curious, what's happening closer to the home? What is DSP Pension Fund offering under MSF? Being existing investors and also for new investors, what are the choices we are going to be getting from DSP Pension Fund?
Yeah. So I will just take you through the product design, and then I'll request Ramneek to talk about his investment philosophy and how he's going to manage the scheme. But if you look at the product, what we have done is we saw a white space in terms of long-term equity, because today the customers in NPS couldn't go beyond 75% equity. And we, through our social media interactions and physical interaction with a lot of customers, we always felt that customers want 100% equity, especially people who are younger and want to take huge risks. They have 15, 20, 25 years towards retirement or to achieve their goals. They were not wanting to wait and say why and to be invested only 75% equity. And that is where this was the white space. And we have launched a scheme which is called DSP Pension Fund NPS Long Term Equity Fund. Here the equity exposure will range between 80 to 100%. It is an actively managed equity scheme where 80 to 100% will be in equities and the balance could be in debt and money markets. The money markets could be the liquid cash, or money markets could be 10%. The fund management fee, as I mentioned, is 30 basis point, and anyone who's from age 18 to 75 years of age can join this scheme. And as we talk, the further reforms are even talking about that you can stay invested till 85 if you need to be. Now, so that further opens up the scope for people to join the scheme at whatever age they want. So this is what we have launched as of now. In the coming times, we and other fund managers can also launch new schemes depending on where we find white spaces for our customers and what offerings we want to create for them basis their needs. But currently, we have just launched one scheme as we believe this is the need, and rest of the needs are taken care by the existing portfolio, which is active or auto allocation. Over to you, Savannah.
Okay, so coming back to Ramneek, managing retirement money is a big, big responsibility. We would want to know and we would want to understand what's your investment philosophy for this new scheme, and how do you foresee growing wealth for your investors while you keep risks under control as well?
So we are the ones who have published our investment framework, on our blog, and we frequently talk about it on social media, and we are the ones who are sharing our fact sheet the way mutual funds do, because I think that's just the right practice in terms of transparency. And if you look at our framework, it doesn't change for the new scheme. And, we remain one of the most long-term oriented investors. And if you look at our portfolio churn, which is, how fast we are trading in the stocks, it's the lowest. Last month, it was close to, until last month, it was close to 11%. So that basically shows you, that basically translates to somewhat around 10 years of holding period for each company in the portfolio. So we are very long-term oriented investors, and the philosophy remains the same. Like we like the companies which have low terminal value risk, which have a huge long runway in front of them to deploy vast amounts of capital. And we invest in companies which have return on invested capital, ROIC, higher than their cost of capital, weighted average cost of capital, and are growing with sensible reinvestment of their cash flows. And then, one of the criteria we look at is to qualify as a portfolio company is adaptability of the management and the business over time to protect itself from the competition, because we are a free market society, and the competition just keeps coming in. So how adaptable the company has been in its previous avatar. And then resilience actually matters. If there is a possibility of technological disruption and innovation sidelining the business model, we have to be very, very careful with that. Because we are long-term holders, so this can work in reverse also. So if we miss anything and we keep holding a company, we could go through a substantial drawdown on, and we don't want that to happen. So we have to be hyper aware of what is happening, and we closely monitor each and every business on a regular basis. And we have, like, high active share. We are close to 62-63%, which is higher than way far, higher than an average active share for a fund, be it in any industry, and in the fund industry. And if you look at, we also look at intangibles, which could be mind share. And mind share just means, how fast a consumer can recall a certain product or a service, and want it just for the name of it. Right. So it could be brand name, but like mind share is when you really want the product and you just want that one. So we look at those kind of intangibles as well. And there could be some regulatory captures as well. Regulatory captures could be, for example, you cannot start a tobacco company today uh, because the government doesn't provide any more licenses. And if they end up providing you a license, you cannot market it. And then there is another competitive advantage, which is you cannot market it. If they open up the marketing, they're going to open it up for the existing, companies and businesses as well. So those are the things broadly we think of getting into the business. And some of the private banks, some of the PSU banks fall under the regulatory capture framework as well, where it's very, very hard to get a banking license in India, even if you are a conglomerate. So those things really matter to us. And so we do long-term investing, and we don't churn, buy and sell too often. We just keep adding to the positions at reasonable prices whenever. So we have about 26, 27 stocks in our portfolio, and one or few companies at certain point are doing well and few are not doing so well, and we just add to the companies which are going through a temporary sort of a drawdown. And so that way you just compound wealth. And the idea is to reduce the number of transactions and the decisions you make. So the initial decision of buying has to be really, really sound. So you don't have to make a lot of incremental decisions where you could be wrong. So that's how we think about it, because we are very cognizant of the fact that we are managing, someone's lifetime savings on which they are probably relying to retire. So we need a lot of sustainability in the companies. We need reasonable prices, or actually attractive prices, and we need good businesses and very, very low leverage on those businesses to do well.
Great. So it's very clear what you are looking at is long-term growth through these schemes. Now, talking about overall portfolio management, many salaried individuals like us, we are already investing in mutual funds. Now, I want to understand, how does it fit with my mutual fund portfolio? Should NPS MSF work alongside that as a complementary long-term portfolio? Rahul, Ramneek, this question is for both of you. It would be great if you can explain
I'll
this.
take that question, Savannah. I think investment into mutual funds gives you a diverse range of objectives or to fulfill your financial needs. Uh, till till the time MSF was not launched, uh, it was purely NPS was purely from retirement objective because it was pretty long term. But after the MSF coming, I think you can use this product for long-term financial goals, whether not just retirement, though retirement is one of your critical roles, and as we all say, NPS zaruri hai. Uh, uh, Similarly, you can use this for your child education, because 15 years is a product where if my daughter or my son is born today, they are going to go to college when they turn 17, 18 years, and where I start investing for them and take that money out when they're closer to retirement. Similarly, if I have goals, long-term goals, any long-term, whether it's my kid's marriage, whether it's I have to buy a house, means you can, or I have to create generational wealth, I can still use this product to transfer generational wealth, which I've created through NPS, and transfer it to them. Because if I invest long-term and I buy annuity, and after my death, their product where the entire purchase price is given to the nominees. So in a way, I can use this product to transfer my generational wealth or wealth to my next generation. So this product is no longer a retirement product now. With the MSF coming in, we can help subscribers meet their long-term financial needs and goals through this product. And as of today, we are offering investments in limited asset classes. But as we move forward with the changes in the investment framework, you could have dynamic funds, you could have different kind of funds where you could invest a larger portion of money in also into alternate assets or metals. All this put together, I think, will give, or maybe the international market, we don't know, right? So all this will give will attract a lot of investors with different needs to come and invest in MSF scheme, as long as the goals are for long term and not short term.
Great. So, Rahul, let's talk process now. How do I actually sign up to opt for MSF for that matter? What's the process both for existing subscribers and the ones who are just about to join NPS? It's a smooth digital process, or how is it? It would be great if you can explain that.
Yeah, it's a smooth digital process. If any customer has to open an NPS account, they either visit the CRA websites, the ENPS websites, or they go through the POPs. And when they're opening their account, I'm answering this question into two parts. One is for the new customers and for the existing customers. The new customers, when they're opening NPS account, they can either go through ENPS or they can go through the points of presence, who are the distributors. And when they are selecting the fund managers and the asset classes, there the MSF schemes are visible across, whether it's protein, whether it's KFIN, or it's CAM. All the three CAMs, all the three CRAs are offering on their platform through ENPS module. Even through POPs, when they are only POPs who have API integrated processes, there it will take time because APIs for these schemes are not available, as long as it's a redirection model. So here, as of today, I think some customers will face difficulty where it's a fintech and it's a completely digitized model created by the fintech through APIs. For example, ET monies and something like that. There, I don't think that scheme has become active today. But wherever there's a redirection model, and some of the POPs have redirection models, there the option is available. What I've heard from CRS, they've also opened this scheme for a lot of corporate customers. Uh, and when employees want to change their scheme, they have to just reach out to the employers and say, we want to change it. And it's all done digitally. It's no physical forms as of now, what I know. But for the scheme to become active or available across the platform through APIs, and that will, I think, another 15, 20 days away from now, because we launched in 1st of October. When we launched it, it was not even available on the CRS platform. But what we have seen is we have progressed so far in 1 month. And in next 1 month, I think it will be available across all platforms, whether it's fintech, redirection model, or through APIs. And that is where customers, it will be easy for all the customers to get into the scheme.
Great. We do have a few more questions for the team, but before that, to my audience here, if y'all have any questions that is not something that's yet answered, please put it in the chat box, and we would love to have your questions after this conversation. So Rahul, while you were explaining the MSF schemes, in the beginning of the conversation, you did mention about the flexibility to switch from one scheme to the other. And since not everybody is a pro, and we would want to know a little more on the flexibility of this switching strategy. And with that, if you could also highlight a little bit again on the exit options for NPS, because that's quite a common question that a lot of young individuals ask, especially when we take a lot of wellness sessions for our corporate partners. That's quite a common question. So if you could just help the audience understand that a bit better.
So Sumanna, one question is for the exit. How do I exit? I'm sorry, I missed the first question.
So the switching strategy, the switch strategy from one option to the other, because you mentioned that it's quite flexible now. And of course, what are the exit options from these schemes if anybody wants to go ahead with that?
Sure. So to answer your question on the switch strategy, if you want to switch from common schemes, which is the existing schemes, we call them common schemes now, after the coming of the MSF, to MSF, you have to just go through the CRA portal and see where do you want to invest, and it's all available digitally. So you have to just say, I want to switch my asset class, and there you will see multiple schemes available by different fund managers, and you can select where I would request before you select, please understand what the scheme is all about, what is the objective. If at all, most of the fund managers have put it on their website, so you can get the visibility. If you want from us on the chat box, we can also share. We have FAQs and how the scheme design works. Now, once you've made a decision, then you can decide whether you want to invest all the money with one fund manager, or you want to split it among 3 or 4 fund managers, given their fund performance and their investment framework. So you could do that. It's not that you have to invest only with one fund manager. So if I have 100 and I want to split it among 3 fund managers, I can do it. I want to go with 1 or 2 or 10. You can do as much. Now, coming to your second question, that what are the exit options, right? Under the MSF scheme, you are still governed by the exit regulations, which means 60% of the lump sum after 15 years you can withdraw tax-free. You have to buy pension. For some reason, you have to do multiple withdrawals, or you can withdraw 25% of your initial contributions, self contributions into the scheme 3 times over a period of 15 years. Again, that is part of the exit regulations. Depending, for example, if you have building house, some medical needs, and the process is very, very simple. You have to just declare, I want to withdraw for this reason, and you can withdraw 25% of your contributions, not from the employer contribution. And as we mentioned that, I'm repeating it, as I mentioned earlier, the existing money from NPS cannot be transferred to MSF schemes. Only incremental money can be invested in MSF schemes. And for some reason, because these are gestation period is say 15 years, if you don't like the scheme or you don't like the fund performance, you feel you made a wrong decision, you can always go back to the common schemes. And when you go back to the common schemes, you have all the options to switch between asset classes, different fund managers. That's not gone away. That option is still there. And that's a wide range of options. You have 10 fund managers managing your different, you can choose the asset classes. Now, in the exit, when you're exiting 60% lump sum, 40% you have to buy annuities. Then annuities also you have multiple options, which annuity to buy. That's a different subject. I think we can cover. A lot of also have options to, today I don't want annuity. Can I delay it? Yes, you can. You don't want lump sum. You want systematic withdrawal. You can do that today as well. So I think this is a detailed subject on how I can exit from NPS. What are the options available? Can I invest more? For example, I need to buy, because a lot of employees, when they're retiring, they feel that the overall kitty from NPS is not enough for their pension or to sustain. And at that point of time, people get their PF money, gratuity money. Can you invest into NPS before exiting? Yes, you could do that, because proceeds from the NPS are tax-free. up to 60%. So you can, in order to get better pension at retirement, you can invest your PF money and gratuity money into NPS account and then withdraw and buy annuity, which is at a where you get a larger lump sum. So there are many options available. I think on the exit part, Shavana, we can do a separate session because that will again take away at least 40-45 minutes to 1 hour, and we can go into detail.
That's exactly was my thought process, and I was already planning the next session with you, Rahul.
Yeah.
Rahul, my last question is for the corporate NPS investors, where you mentioned that it's applicable for them as well. Anything in particular that the HR or the payroll team should keep in mind when they're offering, these options or the switching to these new options? I understand that this is specifically for the new money coming in and not for the money that's already been invested. So,
Yeah.
any message that you would want to give to the HR and payroll team to manage the new MSF?
Absolutely. See, there are a lot of times when you open NPS accounts for corporates, there are times when corporates decide the fund manager and the asset allocation. And any employee who joins NPS through that corporate gets logged into that scheme, the fund manager as well as the asset allocation. Now, I think given today you have so many options, every employee has its own different needs. I would request HR and payroll team to please look into it, that please make those options flexible for the employees so that employees can choose their asset allocation. That's the beauty of NPS product. You can choose your asset allocation, you can choose your fund manager. If you get if it is locked by the corporate employer at the back end, the employee cannot make a choice of asset allocation. He cannot even choose the fund manager of his choice. So then again, if you had to do that, then why NPS is all about choice. It's not about restrictions. And if employees want to get into MSF and if it's locked in at the back end, then it becomes a problem for the corporate as well as for the employee. I think uh, if at all you were offering this uh, mandated scheme on the PFM side and the asset allocation, by default it should get opened after 1 year as per the regulation, because after regulation any scheme directed by the employer is only for 1 year. After that the employees have the right to choose as per the regulation, and a lot of employers don't know it. And if it is not being opened after 1 year for employees to choose, you are breaching the regulation, you are breaching the guidelines. And I don't think any employer would want to be on the wrong side of the regulation, because and if it's being done, it's being done unknowingly. I'm pretty sure there's no intention of any corporate to do it. But I believe the knowledge of the scheme, how it works on the payroll and HR, sometimes they don't understand the scheme, and sometimes POP's systems are not enabled to make it active for the uh, employees to make a choice. So if that's the case, that's a main hindrance. And after this scheme coming in, I would request, if please make sure that this scheme is available on the platform where employees are making a choice, because a lot of time employees have to go to the payroll systems and say, I want active allocation, I want 70% equity. Now when they are giving that options to payroll team, they should give an option of an MSM scheme and the fund manager as well. So whether it's been that option is there on the payroll system or not, when they're making a declaration basis which you will deduct the money and pay the contribution to the POP, that also needs somewhere, I think the platform needs to get changed to enable it for the employees.
Right. Thank you so much, Rahul and Ramneek, for taking us through all these changes, the changing landscape of NPS. How can MSF give us more choice and flexibility in terms of the equity exposure, or maybe how long we want to stay invested, whether we want to continue with the old schemes or the new ones? I'm sure our audience may have understood and have gained great knowledge. To all the audience out here, if you find today's session to be useful, please share your feedback and inputs in the chat box. And also, we are now ready to take your questions. I could see a couple of questions already in. I'll just take some of those questions for Rahul and for Ramneek. So, Rahul, the first question is from Amit. He wants to know, for existing corporate NPS subscribers, what is the action that his corporate need to take for enabling future contribution to his MSF scheme? Though you did mention some of the points in our previous conversation, if you've missed out on something, or maybe you want to just reiterate a few points, that could be helpful for Amit.
See, Amit, it's a very valid question when it comes to corporate employees. The only thing you have to see is whatever platform you are using for employees to select the fund manager and the asset allocation, there the MSF scheme is visible, whether it's internal or external. Internally, if you have created some platform, I remember in my company, previous company, we had this platform which was on the payroll system where employees could say, this is the choice and this is the money I want to invest in this choice, basis which payroll would make the deduction. And similarly, if wherever you're capturing that choice, whether it's a POP portal or your in-house portal which is managed by a third party or self, please make sure that it's enabled. If not, you can talk to the POPs. If you're facing difficulty, you can reach out to me and Ramneek, sorry, us as well. You can write to us on our company website where you can reach out to us, and we can also help you there.
Thanks, Rahul. The next question is from Manoj Kumar Batula. And he wants to know, are the AMCs allowed to disclose the respective MSF scheme stock portfolios? And on what basis or criteria can one choose one?
I would answer this question in two parts. The first part is yes, you can. The the pension funds are authorized to declare their portfolio because we are under the public scrutiny. Nothing is hidden, and these are NAV-based products like any mutual fund schemes or pension schemes. You can always track our portfolio and our NAVs online. Now, why they should choose, how they should choose, I would request now Ramneek to step in, and maybe he's the right person to answer this question.
So yeah, in terms of your understanding of how to choose a fund manager is not how the fund manager has performed, but it should, or short term, but it should be based on uh, the trust, whether you can stay invested with this fund manager for a long period of time. And it could be us or it could be anyone else. But you have to make a choice, today, that you are going to stick with the thicks and thins with this fund manager, because at any given point of time, one fund manager is outperforming the benchmark, the other is underperforming. And these performances come and go in the short term, but over a long period of time, sustainable frameworks and sustainable investing frameworks and first principles driven framework work with fundamental approach do really really well. And people who are fund managers who are very valuation conscious would do very well over a long period of time. So depending on your understanding of how these companies are in the portfolio, you would be able to judge the fund manager. But I would just say, either get in touch with the fund house or get in touch with the financial advisor to understand better whether you can, or read a lot of investing books to understand how a fund manager is investing and whether it's suitable for you. But I would just say pick a fund manager who you can trust and stay invested with for a long period of time, and you are not losing your mind when he or she is underperforming.
So, Ramneek, the question to you is, if you were that customer and you had to choose a fund manager, for a layman, how would you choose a fund manager who can build trust in you? What are the ingredients of a fund manager you would choose to get that trust?
So first, I would love transparency. How transparent the fund manager has been in terms of communicating their investment strategy and how they are disclosing their portfolios, how they are communicating, how approachable they are. So this is one of the, and this could be on a fund house perspective, from a fund house perspective, or it could be from a fund manager's perspective. So something has to be, the fund house or the fund manager has to be really approachable, where you can just sort out your queries, however basic they are. And and you have to understand how the fund manager has behaved previously. If he or she was shaken out of the market during, something like a 2020 or 2008, probably they are not the right fund manager to manage a pension fund. But if you see a fund manager who basically ended up deploying a lot of cash during 2008, 2020, or during like significant drawdowns, probably you have a fund manager who is driven by sensible approach to investing.
And Ramneek, what have you done to get the trust or earn the trust of the investors, if you can share that?
So yeah, I don't know whether I have done enough, but like we communicate. We are the only pension fund who communicate in terms of our from our blog directly, where I or Rahul would write a blog and disclosing how we have gone about our portfolio. So I would write about investment. Rahul would write about broad things which are happening in pension fund industry, or how you can pick your fund manager. We have written down extensively our investment framework, and we write our shareholder letters. We write annual letter, we write half yearly letter. We wrote one just in the month of October, and people can come and read it, and people can easily read it, and we share these letters and blog posts through our DSP Pension Fund social media handles, and our personal handles as well.
Thank you, Ramneek.
Great. The
Also,
next
we are
question.
the only ones who disclose our fact sheets, just the way mutual funds do, because currently the regulator, like on the mutual fund side, doesn't mandate the pension fund managers to disclose their fact sheet, but it tells you to disclose the portfolio. But portfolios in Excel could be very cumbersome for a layman to just unravel, but we disclose it in a very neat PDF form, where you could just see all the holdings at one place, and that would be true for the MSF schemes as well.
I think that's a very interesting thing, Ramneek, that you just mentioned, releasing the fact sheet, because that is definitely going to help a lot of new investors as well to understand what's happening with the fund and how are they positioned. All of that information. Thank you for that input. The next question is from Nasser Kardas. He wants to know, can I transfer my funds from one scheme to another? To which, of course, you said yes. If so, is it possible to transfer it in full amount, partial amount, or both? Also, if you can explain how that works, are there time restrictions or frequency or limits applicable to such transfers? I think, Rahul, you can probably
I
answer
can.
that.
So you cannot transfer your fund from common schemes to MSF, but within the common scheme, you can change your fund manager, you can change your asset allocation, whatever you want to do. There are time limitations to that. Uh, but if the question is, can you transfer your lump sum money or partial money from common schemes which are lying in your existing NPS account today to the new scheme, the answer is no. Clearly, there's clear mandate that only the fresh contributions or the future money can come in. Now, if you have allocated to a one fund manager for the MSF, suppose you invested in DSP, your 100 rupees, and you don't like DSP after say 2 years or 3 years or 4 years, and you want to say now give it to another fund manager. You can't do that under the MSF scheme, but you can always go back to the common scheme and change your fund manager and asset allocation. Similarly, if you're parked money with multiple fund managers, then you can definitely increase or decrease with that particular fund manager, but you cannot transfer money from DSP to say SBI to UTI to Axis under the MSF scheme. Within the MSF scheme, you cannot, but from MS scheme to common schemes, you can do it. And within the common scheme, you can change the fund manager and asset allocation. So if I have answered your question here, so Mana, if I've not, we can go into further depth.
Yes, absolutely. So I see a lot of questions pertaining to the application. The last question that I would take is from Sanket. He wants to know contribution of MSF funds and contribution of common schemes funds are shown jointly on the NPS app or separately.
So, to be honest, I've not seen it, but I think it should be, because these are different schemes, you will be able to see them differently. So it will be segregated, and then will have because that's a commonsensical way of, I think, how it should be shown. But to be honest, I've not seen it, though I've invested in a new scheme framework, but I've not seen the statement. And I think that should be the way, and it should be. If not, I will speak to the CRAs and make sure they are segregated and not clubbed.
Sure. With this, we would bring an end to this lovely conversation with Rahul and Ramneek. And I'm sure this may have helped you a lot to understand the new MSF schemes. Stay tuned for more conversations on NPS in the upcoming episodes. Till then, stay invested and stay retirement ready. Thanks once again for joining.
Thank you, everyone, for joining in. Thanks a ton.
Thank you.
Thanks for your time, guys.
Returns under NPS are subject to market risk and performance. Tax benefits are subject to amendments as per applied income tax laws. Contact your financial advisor before investment.